Hi, I'm Paul Merriman. And if you're a first-time guest to our Bootcamp series, I want to take just a few minutes and talk about the purpose of this series because I do think it is the most important work that we do. Now, this presentation, stocks versus bonds, this is really the number one decision I'm talking about in terms of impact on your financial future. And so I want to make it very clear the implications that you might make about whether you invest in stocks or bonds. And then we'll have following series of presentations that will again address what I consider to be some of the most important investment decisions of your life. I mean, at some point, you're going to have to decide how to build a portfolio for your risk tolerance and your desire for return. How do you do that? How do you pick the mutual funds or ETFs to accomplish that? How do you think? How do you live and understand the process of accumulating money over a long period of time? Of these, I think, are really important decisions. But I do want to start from the ground up. And even though we have already recorded some of the later pieces, and you can go see them if you wish, this is truly the one that I think is number one. And so, as we get into what I consider to be the biggest decision you will ever make regarding investing, stocks versus bonds. And I have to assume that some of you are beginners. And so I don't want to leave you behind. I want you to be with us right from here on. In the beginning, this decision, stocks versus bonds, should be driven by the understanding of what stocks historically do and what bonds historically do. At age 81, I've got both stocks and bonds in my portfolio. Stocks for growth and bonds for income. But to understand the ownership of a bond or a bond fund, a stock or a stock fund, understand this. In the case of a bond, somebody is promising to borrow money from you, pay you interest, and pay you back the principal on that loan at some point in time. That's called the maturity. Sometimes people will loan money for 30 days. Sometimes people will loan money for 30 years. But you don't own any part of that company. Well, you might have a call on the company if they go into bankruptcy. And because you're a bondholder, you would be paid before the shareholders get anything, the stockholders. But the bottom line in most cases is that you are going to loan money, get a relatively low rate of return. And why will it be low? Because somebody is saying, I guarantee to pay you back a certain amount of money over a period of time, the interest, and then the principal. Now you compare that to the stock, where in essence, the sky's the limit. I was just looking at some historical returns of companies that are up 20,000% since they started some years ago. Others are worth nothing. And of course, therein lies the problem with stocks is they can virtually go to nothing. And some of the names that were at one time household names, like, well, let's see, uh, Washington Mutual would be one that would certainly come to mind. Enron, another one. Eastern Airlines, another one. At one time, profitable organizations, but in the end, the shareholders took the ultimate risk, losing everything. Of course, this is obviously the reason when you are going to invest in stocks, we want you to invest in a mutual fund, of a whole broadly diversified portfolio. And we'll talk about that in a few minutes. But the key is with stocks, the sky's the limit. You could, if you invested all of your money in one company, make hundreds, thousands of times what you put into that company. And there are actually quite a few of them. If you look historically, about 1 out of 25 will have a great track record. The other 24 don't do that well. But when you put them all together, the good ones and the bad ones, you'll see in just a second that the long-term return has been, and we always have to say has been, because we can't buy the past and we can't know the future. But that owning all of them has given people a really fine return. So, what do we know about stocks? Lots of potential return. Bonds, small potential return, but the bonds are, at least on a short-term basis, very, very low risk. When you buy a 30-day T-bill, US government T-bill, I don't know what they're paying today, but let's say they're paying 4%. For 30 days, on an annualized basis, you will get that 4% and you'll get your money back. And that has never failed to happen since they started 100 years ago, plus paying and borrowing from the public and paying them back on a regular basis. If we ever stopped doing that, that would probably be a catastrophic event for our country. But bonds are very low, low, low risk on a short-term basis. Now, if you have longer-term bonds that mature in 30 years, they will be more volatile because bonds do go up and down depending on the direction of interest rates. And so while there's some volatility, I'll show you that volatility in just a minute. In the bonds, it's nothing like the volatility of stocks. With stocks, you could easily, when I say easily, it's happened a number of times that all stocks go down on average 50%. It happens. That is not true of bonds. The problem with bonds is that if we're building for a long period from now, putting money away for retirement, and you're just getting started, you don't want to have your investments in something that pays a very low return for a very long period of time. You don't need the money in the next year. You don't need the next money in decades. Maybe it'll be 4 decades before you'll need the money. So you have the good fortune of being able to take the volatility of the stock market. Now, at age 81, my wife and I only have half of our money in the stock market. The other half is in the bond market. So there's no recipe for everybody here, but we've got a pretty good idea of how young people should address the risk of stocks and bonds. And we have a pretty good idea of how older people should address that combination of stocks and bonds. They're both legitimate holdings. But boy, when you don't need safety for the short term, long term, then stocks are a way, way better decision. Let me show you some numbers. Now, I don't want to say I live and die with numbers, but I think people who know our work will say that we have more numbers than most. We want to see the evidence. We want to see the evidence from the past that doesn't just show what happened in the last 10 years or last 25 years. We want to go back as far as we can and believe that we're getting legitimate results of what the market was like then. So we have in this presentation a lot of information going all the way back to 1928. And I didn't dig that information out. That was the work of the academic community. They have the hordes of people theoretically available to help them dig out all this past. Now, I recently debated somebody who really he didn't make fun of me, but he was saying that all of this information from the past is not evidence, that it isn't something we should rely on. My problem is, I feel like I'm at a fork in the road. And that fork in the road is, do I trust a long history of results and see enough of the good and the bad times that I feel like I do truly have an idea of how this process is going to work out in the future that I can't know? So I could very Pollyanishly paint a picture of the future that it is absolutely fantastic. You are going to make so much money and it's going to be so easy. All you have to do is, well, the fact is, nobody knows the future. Nobody. But we do know the past. And what we're really concerned about, because we can't know how much we'll make in the future, we can believe wholeheartedly that over a long period of time, you will get a premium for the risk that you take today. If you do it right, by the way, you need to do it right. You need to be very prudent. You need to diversify, and low expenses are a whole bunch of things I want you to do. But the bottom line is the odds are it's going to work out for you. Now, if that's true, what I really need to understand is, what do the bad times look like? Because if I can get a sense that everything is likely to be okay for the long term, that whatever challenges we might have as a country right now, we've had similar, they never feel similar, by the way. I mean, try to make the case that what we're facing today is so tough compared to the Depression. I don't think the people who went through the Depression would equate the two. I think they would say the Depression was a much more difficult time than whatever it is we're going through in the US today. So I want to see the bad times. I want to know what it looked like in the bad times, because my belief, and it can only be a belief and nobody else can know any better, is the past will look like the future, I should say, will look like the past. If last year the market was up 25%, and it was, I'll bet you there are lots of times the market was up 25 to 30% in the past. And it's true. In fact, I'm going to give you the proof of that today. You can go through and look at how often the present looks like the past. What we can't know is what is called the sequence of events. I can tell you that the market has gone down 50% or more many times. I can even give you the dates, but I would never be able to tell you those dates in the future. I would only say, I believe if you put money away into the stock market today, that over the next 40 or 50 years, if that's what you have the good fortune to be able to appreciate and grow for you, that you'll probably have 2 or 3 times that the market will go down 50%, which is one of the reasons my wife and I have money in bonds for half of our portfolio. So enough of that talk. Let me take my little red ball here and walk you through 3 different levels of risk in bonds. One is called a short-term bond. In this particular case, these are 1-month bonds that you could loan to the government, get your money back, loan it to them again, get your money back, plus the interest. And just every month you continue to have this 1 month at a time, a loan and then repaid, for which you don't make much, because you can see that over the last 97 years, it has grown at 3.3%, which turned $100 into $2,286, assuming you left the money in there and it compounded. Money growing on money. So if it made 3.3% on $100, the next year If it was still paying 3.3%, it would earn 3.3% on $103.3, and it would keep building and building and building. Why is it so little money over 97 years? Because it's very short term, it's guaranteed by the US government, so there's almost no risk, at least so far. Then we look at intermediate term bonds. Now, this is a different kind of a bond. It means in this case, it's a 5-year bond. Instead of loaning for 30 days, you loan for 5 years. And so you're taking more risk of having interest rates go up and down and causing the underlying value to go down and up. The point here is for the little additional risk that you take to go from the short term bond to the intermediate term bond, it goes from 3.3 to 4.8, and your $100 grows to 9,712. Now, the most volatile, and I think this is really important that you understand, three very different kinds of bonds. And there are many other kind of bonds. These are government bonds. We could do the same have the same conversation about corporate bonds, high grade corporate bonds, low grade corporate bonds, international bonds. There's a lot you could know about bonds, but these three are the most common. And we're going to learn our lessons about risk and return from these three because you did get a premium. How do I find that there's more risk? Look at the worst year return for the short term bond, about 0.02%. Very small negative year. And with intermediates, there was a year, and it just happened several years ago, that the intermediate term government bond went down 9.4%. Now, the bond is still going to mature and pay that original bond value, but in the meantime, it went down as interest rates went up. But long-term government bonds, where you're waiting for 20 to 30 years to get your pay, and now you're guaranteed to go through some periods of higher interest and lower interests. And what do we know? We know for taking that additional risk, you got 5.1% instead of 4.8. You ended up with about $12,000 instead of 9,700 or instead of 2,300. Risk and return. Take more risk, get higher return. Now, is it possible you could take low risk and lose everything? Well, where would you cash one of your Confederate bonds that a relative may have left you from a long time ago? There are bonds that, in fact, go out of business and have no value. That's certainly not uncommon in the junk bond market. Anyway, you got the idea. And I want you to notice this. This is really important. Notice the volatility of the best year of the last 97 and the worst year of the last 97. The best year for short-term bonds was a gain of 14.7%, and the worst year was, as I mentioned before, a loss of 0.02%. On the other hand, the intermediate term bond, its best year was a gain of 29.1%, and its worst loss was 9.4%. The long-term bond, the best 1 year, was a gain of 40.4%, and the worst was a loss of 26.1%. And by the way, that loss of 26.1 did not happen in the Depression. It just happened a couple of years ago. And I will tell you, it was a shocker. And some people came to the conclusion that bonds are a terrible place to put your money. The stocks are better than bonds. Well, it turns out, by the way, that one bad year does not change the characteristic of the underlying asset class. And so what happened was the series of events were just such that during a period of time that interest rates quickly increased, the bonds, particularly the long-term bonds, quickly decreased. Now, again, they will come back and pay the value of the original loan at maturity. But you may have to wait around for a long time to get the money that you put in right before that big loss happened. So this is one asset class, bonds, showed at three different levels of risk: short-term, intermediate, long-term. I do want you to see, let's remember this best 1.14.7 and worst 0.02%, etc. And let's look at what happens to the best and worst years as we go to the next table, where we are looking at a 15-year period starting in 1928. There were 83 of them. Yes, some of them, of course, overlapped, but there were 83 starting with each calendar year, 15-year periods. And here's what we know, that the average compound rate of return was 3.6 for a year instead of 3.3. The best was 8.3, and the worst was a gain of 0.2. So we have narrowed the spread between the best and the worst. And when we look at the intermediate term government bond, it is 5.2, and the long-term government bond 5.6. Those were the average 15-year returns. And you can see again, let's just look at the long-term bond. Remember, the best was like 40%. Well, now it's 13.5. And the worst was a loss of 26%, and now it's a gain of 0.4. The longer you invest, the more normalized and the narrower that range of likely outcomes is, at least based on all of history to come. Now let's look at 40 years. 58 40-year periods. What do we see? The average 40-year compound rate of return is 4.4%. What is the average of intermediates? 5.9. What is the average of long-term, more risky? 5.9. So the reason I am not a fan of long-term bonds is because you have to take an appreciable additional risk in long-term bonds to, in the end, likely get the same return as the intermediate term bonds. But notice again, as we go out and look at longer and longer periods, the spread between the best and the worst declines, more predictable. So when we talk about what your 40-year return in bonds are likely to be, I can't tell you for the long-term bond whether it'll be closer to the 9.7 or the 2.3, but it will be more than likely within that range. The same with the range of intermediates from about 8 to about 3. And with the short term, 1 month, 6 to 1.6. It gives us at least some way to predict what it is likely to be. And of course, that also assumes the U.S. government is still there paying their debts. But now we look at stocks. I mean, this is the reason we're here, and this is to really think about how much we want in stocks and how much we want in bonds. And we'll do a lot of work later in the series about people who are in retirement. But I will tell you, for people who are just getting started, and on May 29th, I have the honor of addressing, I hope, 200 to 300 seniors at Western Washington University. And I will tell you, I'll be beating them up about stocks. I'll be making the case that for that 401k money, I want you in at least the first 20 years to be putting your money into equities. And this is why it's the same $100 that was invested in 1928. Now we have four different levels of risk, and it pertains to equities. I am not going to try to look at the return of equities one at a time. But what I am willing to do is to look at an index that, in essence, represents all of a particular equity asset class. But I do know there are big companies. Well, that would be this one right here, LCB, large cap, big companies, balanced. Balanced how? Between two kinds of equities. One is called growth. Those are the companies that we love to talk about. We like to brag about having invested in them because if we picked the right ones, we made a ton of money. Growth companies not only during certain times produce unbelievable returns, but when you look at what people are willing to pay for them, it is literally on average twice the price of what they would pay for a more conservative stock or company or equity asset class. And that price that people pay for the earnings, that's called the price to earnings ratio. So if you have a stock that earns $1 and its PE ratio is 30, it is selling for $30. The price is going to be so many times the earnings. 30 is a normal price to pay for the earnings of a growth company. A value company, another big company, it would typically sell for about 15 times earnings. And that's because people aren't as excited about it. I will tell you what has happened over the past is there are periods when people get really excited about growth. And then when growth has failed them, they get really excited about value and they want to be in something safer. And over a long period of time, it is interesting. The value is in some ways more volatile. Other ways it's not. But I'm going to say it's more risky. And it's more risky because the companies aren't as secure as the growth companies. Growth companies typically have lots of money to grow with. They have great management. These are big companies. These are trillion-dollar companies in some cases. But here's what I know about the past. I know that if I owned all of those, and typically we call that the S&P 500. Let us think of the S&P 500 as the 500 largest companies in the United States. Now, that is not exactly what it is, but it's close. And what do we know about the S&P 500 over the last 97 years? Its compound rate of return has been 10.2. Want to take more risk and put all your money only in big companies that are out of favor, value companies? The compound rate of return was 11. Now, remember when we talked about the $100 with the short-term bond fund, U.S. government guaranteed, the $100 grew at 3.3 and became worth $2,300. $2,300 versus $1,186,081. Now, do you see why we want young people to be in the stock market? Not because they have 97 years to have money grow. By the way, my wife and I gave our youngest granddaughter 2 years ago when she was born money to put aside to grow in her 401k when she qualifies. So that means that money that we gave her can literally grow for 100 years because people being born today are expected, according to the actuaries, to live to be 103. there'll be about a 50% chance you'll live to be 103. So a granddaughter could, in fact, realize this 10.2%. Or if you had made 0.8% more and you had it in large cap value, instead of 1.2 million, it grew to 2.3 million. Oh, the power of time and compounding. And that's why I think it's so important that we teach our young people to be financially literate. Because if they can do this right from day one, they're sitting in the catbird seat. I'll tell you, if they just have the discipline and do the right thing. And the neat thing is the right thing, according to all of the folks that I know that I consider to be truth tellers, it's really a low risk to invest. But it still suggests that in the early years, at least the first 20 years, no bonds. We don't want something that's earning 3.3%. We want something that has a legitimate 10% compound rate of return or even 11. And in just a second, I'm going to show you how easy it is to make 11 with the S&P 500. Stay tuned. Now we have, remember, 4 levels of risk. We have another level, that's the small companies, small cap blend. These big companies are 100, 200, 500 billion and more. These companies are maybe 8 billion down to 2 billion. So they're smaller companies. And there's all sorts of ways why they're more risky. You don't want to buy them one at a time. But as a group, like an index fund, these are a great thing to have in your portfolio, at least based on the past. And I'm going to show you a chart that I hope you will never forget. As a matter of fact, I hope you will come revisit that chart once a year because we update this chart every year. But notice the $100 grows to almost 5.5 million, an 11.9% compound rate of return. Now, the small cap value, it's here. It is risky. Like the long-term bond is risky, small cap value is risky. But there was a premium historically for that risk, 13.2%. Now, I am not for a second promise you 10 or 11 or 12 or 13, because it's not unlikely that all of these will pay less. We don't know. We don't know. I heard Bill Gates interviewed last night, and he talked about artificial intelligence and how it is many, many times more important to our future than the invention of the desktop computer. Now, that's a pretty strong statement. And so who can know what life will look like 30, 40 years from now? But I do know this, that unlike bonds that had a very narrow best and worst, 1 year at a time, there's about a 90% difference between the best and the worst for the S&P 500. It's about 150% difference for large cap value from best to worst. For small cap blend, it's about 160% difference from best to worst. And small cap value is about 180% difference from best to worst. So if you ask me what I think the market's going to do this next year or this year, it will be somewhere in between these numbers. And in fact, I would like to believe that it will start to look more like somewhere in between the 15-year return differences, where instead of having 90% difference, the best and worst difference is about less than 20% for large cap blend. Large cap value, which was like 150% difference, is now around 20% difference, 21%. And even if we go over to small cap value that was just absolutely huge, now the difference is down to about 27, 28%. What I'm saying is that the longer you hold investments like these, the more narrow the outcome becomes. And so when we're talking to young people in their 20s, we're talking about 40 years. When we're talking about people like myself, we're talking about 10 years. And I'll show you in a while a bunch of 10-year results that I think you'll find interesting. So here's what we know about 40 years. The very best for the S&P 500 was 12.5%, and the worst was 8.9. Now that's a fairly narrow range. And I think I could live with that as upside and downside risk for money that I'm putting aside for retirement. I'll be writing an article, we will be writing an article in the coming months about all equity all your life. And we're also going to talk about all 60/40, 60% equity, 40% bonds your whole life. I think you'll find those studies very interesting. But here I'm talking only equity. So you can compare these four different levels of risk. Now, the first thing I want you to see is that the average compound rate of return of the S&P 500 over the last 58 40-year periods is in fact 11%. I told you I would show you how easy it is to make 11. And the reason it jumps from 10.2 to 11 is because you had a handful of years back in 29, 30, 31, 32. The market was just miserable. And of course, when you're looking at very long periods of time, okay, your first year includes, let's say, all four of those terrible years. The next year, you start the second year and you go to the 41st year. Now you only have to suffer one of those bad years. After you get by those four bad years, everything looks much rosier. But they are real. And it isn't unlikely that that will again happen in you, particularly for young people in their future. But I want you to notice what happens here. The range of returns, 11 for the S&P 500, the balance of large cap growth and value is 11 and then 13.4 for large cap value. Then for small cap blend, it's not much more, 13.6. And for small cap value, 16. And of course, those are absolutely huge numbers over a lifetime. I do not expect small cap value to compound at 16% over 40 years. I do think that 12 is a possibility. I know as I look back at the last 25 years, the small cap value fund that I've been working with has been around since 2000, and another one's been around since 1993. But since 2000 in particular, it's been a tough market for the S&P 500. It's been about a 8.8% return, not 11, not 12, not 10. And small cap value has been about a 10.2% or 10.5, I'm guessing now, but a little over 10 instead of the longer term return. The last 25 years has been a very difficult market. Oh, yeah, sometimes it's been good, and sometimes it has just been terrible. Now, I have not been talking about these other returns over here because I'm going to do that in just a few minutes. But I do want you to see that the premium for risk for large cap value, small cap blend, small cap value is it's overwhelming evidence. But this is the long term. When you invest the long term, while you might think about it, and remember that's what it's all about, staying the course for the long term. But short term does have an impact on investors. I was an investment uh, advisor for many years. I started in an investment advisory firm in 1983. And what I found, because you get to know your customers really well as an advisor, when you're going through the period of exploration to understand how they got to where they are today and what lessons they learned along the way. And sometimes those lessons were what I call myths of investing, but doesn't mean that you can't believe in a myth. And what I found was that if I told somebody about a strategy, that it was a combination of large and small and value and growth and US and international, if in the first year or two it did well, they were very likely to be an account for a very long time. On the other hand, if you put people into a portfolio and the first thing that happens is like 1973 and 74, like 2000 through 2002, like 2009 through, 2007 through the early part of 2009, many of those people don't want anything to do with equities ever again because they experienced the downside. If people have made money before they have to face the downside, they are so much more likely to stay the course. So, what do we know here about diversification? I started in the business for a couple of years back in the 1960s. I was a stockbroker. And they sent us away to a fancy school back east. Well, it had a fancy name anyway, the New York Institute of Finance. It was really a sales class on how to sell securities. But they did teach us some things. And one of the things they taught us is that to have a properly diversified portfolio, you only need 10 to 20 stocks. Well, the academics disagree vehemently. Later on, it was determined that if you were going to put money, let's say, into large cap blend or small cap value, or these different equity asset classes, that you needed to have 100 stocks to eliminate the risk of a company going broke and having a serious impact on your portfolio. On the other hand, you can have 1,000 companies in your portfolio, and it doesn't do anything to protect you against market risk. Market risk 73, 74, 2000, 2002, 2007, 2009. In all three of those periods, the market was down 50% or more, somewhere in there. And on October 19th, 1987, the market went down over 22% in one day. That was unsettling. And many people thought it was the start of another depression. So diversification is really important. And as I mentioned earlier, the way to own stocks, because they are so risky one at a time, is to own many, many, lots of many. It is a good idea to own, if you can, 2, 3, 4, 5,000 companies. But I don't want you to own them in one asset class. I want you to have many asset classes. Remember, I talked about large blend. I want you to have it. Large value, I want you to have it as a separate part of your portfolio. Small blend, yes, that too. And certainly small value because it has been the gold ring of equity asset classes for a long, long time. And even looking at the last 25 years, okay, it didn't do as well. It made between a 10 and 10.5, but the S&P 500 only made 8.8. So it was just a very difficult time. You know what happened just before that difficult time? The stock market had compounded at over 17% a year for 25 years. Now, would it surprise you, particularly if you might believe in the idea of reversion to the mean, that the markets go up and they go down, but they seem to go back to a return that we will call, like we do with stocks, the 10% return. It doesn't get 10% all the time. In fact, maybe it only got 10% in 1 year out of 97, 1 year. The rest, that magic 10%, is in essence an average or a compound rate of return. So what happened was, over a very long period of time, you had this huge return for large cap blend, 17% plus. For small cap value, it was over 22. Now, should it surprise us that after having this magnificent return that made some investors think they were really smart? Boy, did they understand the market. And in fact, when people were surveyed in 99 and 2000, most people believed that for the next decade, the market was going to go up 20 to 30% a year. It's one of the things we worry now about people's beliefs is they think linearly. And that market, in fact, from 1995 to 99, the last 5 years of that 25-year run, the compound rate of return was over 28%. So I understand why people thought it should make 30 or it should at least make 20. That would be a bad return. But what really happened from 2000 to 2009 is that the market the market compounded at a negative 1. The S&P 500 did. But here's the beautiful thing. If you had invested in all four of those asset classes instead of one, you would have made money. You wouldn't have made a lot, but you would have made money. Okay, the quilt charts. Overwhelming, isn't it? Beautiful, though, isn't it? All colors. Now, I know some people are listening to this presentation, and we have links to all of these tables. And in fact, I think what Margie will do, and I know she's here with us right now during the recording. Thank you, as always, Margie, is she'll include a link to the PowerPoint, a PDF. So to the extent that you want to go through it and look at this, you'll be able to do that. But here's what I like about the quilt chart. There are a handful of lessons I want you to learn about equities. I really don't want you to try to pick individual equities. I don't have a penny I play with my investments. My investments are, in essence, in the same thing that the people who follow our work are in. Now, having said that, I happen to use 10 different equity asset classes. And what we're talking about here at this time is 4. Now, there's nothing wrong with these 4 because if you put them together, you'll get almost the same return as the 10. but I can't test the 10 all the way back to 1928. I can give it a good test back to 70, but not back to 28. But here's what I want you to see. These colors that you see, in fact, I'm going to make it real easy. I'm going to take you to this next slide, which shows 1 year, 1928. What happened in that 1 year? The academics know. They went out and dug out all the returns for the stocks that would be called the S&P 500 like or large cap blend. And so we make every time we show you the red, that's the S&P 500. The green is small cap blend, SCB. Notice the S&P was up 43.6% in 28, 42.8% in small cap blend. Ignore the next. Then you go to the blue. Small cap value was in third place amongst the four, up 32, quite a bit less. Large cap value up 24.6. Now, please understand, in 1928, nobody knew the S&P 500, small cap blend, small cap value, or large cap value. All the academic research that's been done has happened in most of it, in the last 30 or so years. But here's what we do know looking backwards, that what was in favor in 1928 was large cap blend, but almost the same as small cap blend. What do we know about those two equity asset classes? Obviously, their size has nothing to do with each other, but they both are driven basically by growth. And then at the bottom, you have the small cap value and the large cap value. Those companies that were out of favor, were not growth oriented, didn't do as well. But I want you to notice the four fund, 25% each in those four equity asset classes. 35.8. It isn't the best, it never will be. It isn't the worst, it never will be when these are the five choices. But would I be happy with 35.8%? I would. Would I even know if I had my money in large cap value that somebody had the four fund strategy? No, I probably wouldn't. Most people don't know very much about investing, even though they've spent a lifetime about investing. They've not tracked the intricacies or the 1 year at a time, which is what I'm talking about. And I want to go back to 1 year at a time, but I only want to look at 1 year at a time from 2014 to 2023. Now, what do I know about that period? Well, I know the red, the S&P 500, is at the top of all but three of those years. Now, should that surprise me? After it happens, it should not surprise me at all because I know that sometimes the S&P 500 is at the top. But would I have predicted that? No way. Why? Because I know that over the long term, the S&P 500 should make the lowest rates of return because it is the lowest risk of these equity asset classes. But sometimes they just continue on and on. Now, you'll notice there were 3 years that small cap value was able to do better. In fact, in two of those years that I'm talking about 2016, small cap value was up 37.3, the S&P 500 12. This is one of the most important lessons of this page. of numbers. I don't mean just this page, but the quilt chart that goes from 1928 to 2024 is how in so many years the difference between the number one and the number five asset class is just huge. And if you look the next year, 2017, the S&P 500 is up 21.8, small cap value is up 7.6. Again, a huge difference. So, what do I know about this period? I know that that's an unexpectedly great return for the S&P 500 to be on top that much of the time. I also know it's a very poor showing for small cap value, even though it had 3 years it was number one. There were 4 years it was in last place, and 2 years it was next to last. It was a terrible 10 years for the small cap value. Now, what I like here, I like the four fund strategy here because the four fund strategy uh, has, in the good times, good returns. And in the bad times aren't as bad as how some of the people did or some of the equity asset classes. For example, in 2022, the S&P 500 is down 18.1%. Small cap values down 4.9. The four fund strategy is down 11. It isn't always about how much money you make. Sometimes it's about how much money you lose. And during periods of time of losing markets, when you can do better than others, that bodes well for the long term, particularly if there's something about the nature of particular asset classes that has that happen. Now, I'm going to go to the period 1998 through 2007. A little different, huh? All of a sudden, the S&P 500 is in last place 7 of the 10 years. And small cap value is in first place 6 of the years. Now, small cap value was also in last place 3 years. So either small cap value or the S&P 500 were the worst performers. And oh, by the way, and this is important too, the small cap value that performed so poorly in 98 and 99 and 2007 were offset by the good news. The few good years that the S&P 500 did well, small cap value was bad. Diversification, the four fund strategy, by the way, in the sound investing portfolios where we actually show you the results using real mutual funds uh, starting in 1970 through 2024, you'll be able to see 9 different ways to combine these equities to build portfolios for those who are interested in the idea of wanting to diversify among different equity asset classes. I don't want you to have 5,000 large cap companies or 1,000. That's more realistic, large cap companies. If you have 1,000 companies, I'm hoping 500 of them are large cap and 500 of them are small cap and hopefully value. Now, all of these charts are unique to our work. We are the only organization that offers these, and they are the work of Daryl Balls, who's been working with our nonprofit. We're all volunteers, no compensation for this work for us. Hopefully, for you, our compensation is that you will be there to learn and take advantage of it. and your family will benefit from it. And the family that hasn't even been born yet will be benefited by it. That's our hope. But what Daryl did was not only create these quilt charts, he gave us the bottom line in a way that is really easy to see. He broke down the returns each year by quintiles. So there's a top 20% and there's a bottom 20%. So the number one quintile is the top, and number five is the bottom, and the second, third, and fourth in between. Now, notice, looking first at the top of that list, small cap value, we know it's the most risky, so it will not shock us to find out that it was up 36 of the years, or 37% of the time, and in the top quintile, but it was also in the fifth quintile a little more than a quarter of the time. And 37% of the time it was somewhere in the middle, but really in the middle only three times, or 3%. On the other hand, if you go to the bottom of this table, the S&P 500, remember, high quality, which should mean lower returns. Well, if we go to the fifth percentile, the worst 20%, you'll see it's there 40% of the time. But it is still in the upper first quintile 29% of the time. And it's right in the middle 7%. So both small cap and S&P 500. Well, and by the way, large cap value too. Notice large cap value is in the middle a lot, 60, not in the exact middle, only 6%, but it is 16% of the time in number one quintile and 18% of the time in the fifth quintile. So it's not as wild and crazy as the S&P 500 or the small cap value, but it is more volatile. It is a value portfolio that, as we saw in the table of the returns of equities, has a very high range of volatility. But then if I look at the four fund strategy, what is it that I like a lot? I like a lot that it's never number one and it's never number five. Now, really, I guess I would say I would like it to be number one sometimes, only because I'd like to think that sometimes I'm performing in the top 20%. But the answer with diversification sometimes is you can't get what you want, because the whole idea of diversification is to hold some of the stuff that's not doing well. But 100% of the time, you're in the second through fourth quintile, and 77% of the time you're right in the middle. So what does that tell us? It tells us, if we look at the volatility of returns 1 year at a time, that the four fund strategy is way better than the S&P 500. It is less volatile. The annual returns, how much from 1 year to the next are you going to be up or down, is not as much as others who are only representing themselves as a standalone investment. But here's the part that is the icing on the cake. The compound annualized growth rate of the four fund strategy that has lower risk than the S&P 500 was 11.9 versus the S&P 500 at 10.2. And that is remarkable, because for every extra 0.5%, and this is really impactful for young people, every extra 0.5% means an extra $1 to $2 million more than likely in your retirement if you're saving even what we would consider to be a minimal amount. Now, I wanted to just spend a minute on one more of these quilt charts. Well, I think maybe there's two more, but this one I wanted to show you because it breaks the period from 1928 to 2024 into 10-year periods. There is nothing magic about 10 years, but it seems like it's a period of time that people seem to think that if something happens for 10 years, it's meaningful. Well, please notice that in all but three of the 10-year periods starting in 1928, the small cap value has outperformed everything else. Two of the decades, 10-year periods, the S&P 500 won. Now, in those 2 years that the S&P 500 did better than small cap value, 1948 to 1957, small cap value was 12.9% compound rate of return, S&P 500 16.4. And by the way, it is interesting to note that the following year, 10 years, from 58 to 67, the S&P 500 made 12.9%, which is exactly what the small cap value had made the year before. But the small cap value in this new decade up 22.1. And I hope when you have time, you will take a look at these periods. There are some great lessons. For example, 1928 to 1937, a long-term government bond was the best place to be. Small cap value was the worst. S&P 500 actually broke even. And the reason it broke even is because 1928 was a really good year, really good year. So this is just to show you that over the decades, that small cap value in most cases has been at the top. And this last period, 2018 to 2024, it's not over yet. So I don't know who's going to win because a lot can happen in the next few years. The next quilt chart, bear with me because what I want to do now is take you to the final analysis of the quilt chart. In this quilt chart, Daryl included small cap value and the S&P 500. But he looked at three combinations. A combination 50-50, large and small value. A combination half in small cap value, half in the S&P 500. And then the 25% pieces of small cap value, small cap blend, large cap value, and large cap blend. And he looks at the compound rate of return, and it's no different than we saw before with the small cap value and the S&P and the 4 fund. But let me just add the all value was 12.3% compound rate of return over the 97 years. And the 2 fund strategy was a 12%. So a little bit better than the 11.9 of the 4 fund strategy. What is interesting is that the one fund that is never first or last in this particular study is the 2 fund strategy of small cap value and the S&P 500. And but the main thing, I think the main point to make is doesn't matter which the 4 fund, the 2 fund, or the all value 2 fund, they are very well diversified because in each case, you're getting more than just one asset class. You're getting large, you're getting small, you're getting value, or you're getting value and growth and small and large, or you're getting all four of them. I mean, there's a ton of diversification in any of these portfolios. Now, what you see on your screen is boot camp number 2. And no, I'm not going to give you the boot camp right now. This is the next in this 10-part series, this one entitled The Ultimate Buy and Hold Portfolio. And what you are going to learn in that piece is the impact of little tiny changes to your portfolio. A little bit of small value, a little bit of large value, a little bit of international, a little bit of everything. And what it does to your diversification, what it does to your risk, and what it does to your potential return. And I do hope that you will go there next if you are just getting started with this process. I also, for people who are brand new to our boot camp, we have a whole website that is filled with articles and podcasts and videos, all devoted to educating you to become a better investor. And I have to at least comment about the disclaimer that is on the screen right now. And that is that this is not my attempt to be your advisor. In fact, I welcome questions, but I can't answer questions that imply that I'm your advisor. What I can be is a really good teacher. I'd like to think that I am. I know Chris Pedersen loves to teach, and but we have to say that if you need help putting this together, then you should contact a professional for advice. Our hope is by the time you're done with this series, that if you do have to talk to a professional, it would really be to really, I think, just take a look at what you've decided and pay somebody by the hour to see if there's anything that you have overlooked. And of course, we also have much, we had social media outreach program to try to stay in touch with you and to keep you up to date with the stuff that you're doing. But if you want to write to me, Paul at paulmerriman.com. Tell me if this was helpful. Ask me a question. I can't promise to answer every question personally, but we will try to work them into the work that we do in responding to all of you. So thanks for watching. Share it with a friend if you know somebody who's just getting started with their investment process, and hopefully they'll continue on with this bootcamp series. Thank you very much.